Good morning to all. Okay, we are now going to talk to you about the 2007 results and answer your questions about 2008 and the future. What can we say about the 2007 results for the group? They are excellent. It is yet another record year for AXA, despite the economic environment at the end of the year, which was not as good as one could have hoped. But you will see later on that this does not upset us particularly. Now, if we look at the total business of the group, you see that the model that we have set up is a model that is operational. It works. It's a mix of external and organic growth that enables us to increase our results year after year significantly. Revenues are up 20%. AXA is a strong growth group, thanks to both organic growth and acquisitions. You have to have both, because if you don't have significant organic growth, this means that, in fact, your products, your distribution networks, your organization are not optimal. You cannot have any durable acquisition unless you have a positive, strong, robust organic foundation. The excellent results of 2007 after 2006, 2005, 2004 is thanks to the fact that our organic growth is strong, and also because stronger than that of our competitors, and we have market share gains everywhere. Underlying earnings are plus 27% and adjusted earnings plus 22%. So strong growth last year. If we reason on a comparable basis, the underlying earnings are up 15%, which is completely in line with our Ambition 2012 plan. So 2005, 2004, 2005, 2006, 2007, we are in line with the objectives of Ambition 2012. In fact, we're slightly ahead of plan. If you look at the different business lines, in damages, life and asset management, we can see that we are both in underlying earnings and in income. We are also experiencing strong growth. For life and savings, we're at 8, sort of in the middle. Underlying earnings are up 20%. We wanted to be between 3 and 5 for P&C. We're at plus 4, with underlying earnings up 8%. Asset management revenues are plus 17%, and our underlying earnings in asset management are up 21%. We are talking about solid growth. When you look at where this growth comes from, the growth comes from an excellent geographical platform. It used to be that we would hear, in the way AXA would build up its results, a number of criticisms or remarks about the fact that there are two entities that are strongly profitable, France and the US, and everything else was not so profitable. Today, this is, of course, not true at all. There are 3 main drivers in the craft, namely France, Northern Europe, and North America. Each delivers about 20% of our total earnings. And then 4, I don't want to call them auxiliary engines, but because they're all important, they produce about 10% each. All of the businesses, all of the areas in the company are growing and improving their margins, making good margins. If we look at our adjusted earnings, i.e. how above the underlying earnings, the different capital gains come and accumulate. You see that in 2007, we did a little over 1.1 in capital gain. This is slightly above what our long-term objectives are, which means that our choice of exposure to some of the stronger shares is an excellent strategy, because it enables us to realize capital gain regularly, which improves our results. All of this is the basis for our proposed dividend increase. We suggest 1.2 euros in shares. That's a plus 13% increase over last year, with a distribution yield rate of 42%, which is in the bottom, a payout ratio, of 42% of adjusted earnings, at the low end of the 40 to 50 target range. This gives us a dividend yield of 5%. This demonstrates, if I may allow this comment, that the levels of the present markets are absurd. The dividend yield on in this situation is even something we have never seen. In 2003, the yield, when the yield was only 3.5%. So this is a remark which shows that we're probably in a very exceptional market situation. Now, what about the market turbulence? It has not had a major impact on the group. Limited impact only. Why? Because our business model is simple, and this model is quite robust with respect to external turbulence. We don't have any investment bank type of business, so we are not involved in the problems that the banks have, who structured complicated products, sold large amounts of these products, are no longer able to sell these projects, have to factor in a number of these products into their balance sheet. We invest in assets for long-term growth that are not impacted by present turbulences. And if you look at where our figures and our results come from, you can understand why this model is so robust. About 30% of earnings and 40% of underlying earnings of revenues, and 39% of underlying earnings comes from damages. When you look at the business at the beginning of the year, we're in the same trends as at the beginning of last year for damages. If you look at life and health insurance, we see that this business has no reason to be strongly impacted. When you look at savings and annuities, what we call variable annuities, or life and savings in France, as we call it in France, when we look at asset management, this gives us a total of about 45% of the group's revenues. Sorry, it's of the group's revenues, right? And a proportion in terms of underlying earnings, which is similar. The situation in the present market might have an impact here because our customers might be a little more hesitant to invest in long-term markets when everything is moving around so much every morning. We have, of course, a strong competition of the banks that are looking for liquidities from their clients and who are offering more attractive short-term products. We also have a smaller asset base because when the markets go down, the asset base becomes smaller. But all of these things are relatively indirect impacts that do not challenge either the business model nor the long-term trends. Another thing we need to look at is the quality of the assets. If we could come back to the last slide. If we have made the wrong choices in investments, then yes, indeed, if that is the case, then the present crisis could impact your P&Ls and your balance sheets. If we looked at the last crisis, which was very violent, if we look at the cost of the ABSs, the subprimes, we're talking about 600 million euros, 300 million on the P&L, 300 million on the balance sheet. For a company that has 300 billion in bond investments in its insurance assets, for such a company, this is an exposure, you will surely agree with me, which is quite limited. Where does this come from? Because we have high quality and very diversified assets, and also because our risk control systems that are at the very core of our business are high performance risk control systems. Is business developing every day? When you want to look toward the future, you need to know whether organic growth can be sustained, whether yes or no, we are capable of attracting new customers. When you look at 2007, you have an explanation of the reason why organic growth is strong. The portfolios have continued to grow both in motor and in household rather quickly. This is important because if you had looked at the figures at the beginning of the years 2000, the figures were not only not at these levels, but they were sometimes even negative. So organic growth is now strong. That means that our performance product range is strong. that we are capable of growing faster than the markets in which we are. As concerns the financial types of businesses, we generate about 13 billion euros in assets that are due to grow through insurance businesses for 11 billion euro in 2007 and inflow from third parties for about 30 million euros. So we net positive, 11 billion in LNS net inflows. So net positive cash flow. When you look at life products, the variable annuities products that are retirement and life products that are very successful in the United States, the success of their launch outside of the United States is confirmed. They now represent about 20% in the APE of the group, 14% of the sales of new products in the group. And the share of the products sold outside of the U.S. was multiplied by 4 in 2007, and the pace of monthly sales is increasing. You see, it was 4 million euros per month in APE in 2006. We're now at 25 million euros per month. So the growth of these products outside the U.S. are good. They are good for the customers. They show a good margin for us. These are products where we will continue our efforts. Now, in this environment, under these conditions, what are we continuing to do? The same thing as before. We are continuing to focus on the commitment of our employees and the satisfaction of our customers. Now, why? It might seem distant from our financial concerns, but in fact, this is what will enable us to grow one's business. If we have employee commitment that is stronger than average, they will be more effective, more convincing, better capable of retaining our customers, so we will have better growth. If we improve our quality of service is generally not the reason, it's something for which our industry is popular. If we can improve the quality of our service, we will improve customer retention, and we will therefore improve our results. These are two indicators that we will continue to grow, to improve in 2000, and that we did continue to improve in 2007, but we think we can further improve. Winterthur integration. Now, 2 words about this. 2007 was a year not without challenges, because we had to continue growing organically our business in a more difficult environment while integrating a large new acquisition, which was Winterthur, in the large Winterthur markets. Despite the integration of our operations, their operations with our operations, we managed to gain market share. You know that in most cases, when a merger takes place, during the years where integration takes place, you tend to lose market share. You tend to stagnate. Well, in 2007, we experienced something different. We continued to gain market share. This confirms the quality of Winterthur's operations for anyone who had any doubt, which we did not. And it also confirms our capacity to quickly integrate any business acquisitions that work on the basis of a model that's similar to ours. We're improving in terms of our synergies. Our market shares are also growing. In Switzerland, that was an important point. Here, there was no issue of integration since AXA operations were very small there. In Switzerland, we had an issue, which was, would we manage to accelerate growth? It's too soon to judge, but what is clear is that in a difficult market segment, which is individual life, where the Swiss market is very difficult, we are experiencing significant growth in APE in 2007, which shows that the products that we've introduced, the methods that we've introduced, even if, as François Pierson said earlier on, if it isn't enough, one bird does not announce the spring, as François Pierson said, nevertheless, it looks good. We are continuing to do what we wanted to do to increase our exposure in emerging countries. Why would we want to do this? Well, simply because it enables us to draw 2 benefits: stronger growth in our revenue. As everyone knows, the growth ratios are much higher in these countries than in our mature countries. And the margins in these countries are also significant, since the competition very often is less sharp than it is in more mature markets. If we look at what we've done in 2007, we continued to increase our exposure. We continued, by the way, at the beginning of 2008 as well, in the Mediterranean basin, in Central and Eastern Europe, in Asia and South America, but also North America, with Mexico. If we look at the exposure of the group in emerging countries, the figures in the past 3-4 years, our figures are improving. In a longer term perspective, this is still insufficient. We will continue our efforts in the direction of these regions and countries. We consider that this is a very worthwhile approach. This is our environment. 2007, a strong year. Denis will come back to some of the details. The environment was not so good at the end of the year, but it didn't really affect the quality of our results. Thank you, Henri. Good morning, ladies and gentlemen. I now want to present to you in greater detail the business and results in large segments. You can see that the underlying earnings increased by 27% and 50% on a comparable basis. When we talk about a comparable basis, we're comparing the AXA part with the 2006 AXA share, because in 2006 we didn't have the Winterthur results in IFRS standards. So let's begin by looking at the published results. We see that life and savings increased by 18%, property and casualty by 31%. That's a sign of the fact that the Winterthur share in P&C was greater, so we've increased our exposure in P&C at a time which is very timely, because in a financial crisis environment, this is the business that does best. In asset management, plus 16% compared to 21% on a comparable basis. That's a sign of the drop in the dollar. International insurance grew by 67%, 54% on a comparable basis. I will explain why in just a moment. So we have plus 15% on a comparable basis, and 27% total underlying earnings, with a minus 4% foreign exchange impact. So 8% published comparable basis, strong growth in 19% in the US. We were at the top of the podium in variable annuities. We're number one in the American market, which is the performance that we're proud of. We also have strong growth in Asia Pacific, plus 25%. The other markets are growing less strongly. Japan is at minus 17 due to a change in the fiscal rules that apply to a number of our products. This made the market more difficult for us in 2007. As concerns France, you can see a growth that might seem modest, plus 3%, but this must be compared with a market which went down by 3% in minus 3% in 2007. For the market as a whole, the industry as a whole. In life, 18% plus 10% change on a comparable basis, plus 18% on a reported basis. The US dropped by 4% on a comparable basis. This is essentially due to the impact of the drop in interest rates in the American market and the increased volatility there, and also a reduction in the general accounts part of the portfolio, largely offset by an increase in ULs. In France, plus 15%, sorry, this reflects the increase in the asset base. In Northern Europe, very strong growth, reflecting both an increase in the asset base and the increase in the differential between what we earned and what was credited to insured people. In the United Kingdom, also this strong increase reflecting increased asset base. Japan, here again, the difficulties I already mentioned. Asia Pacific, also strong growth. In P&C, plus 28% change on a reported basis, plus 4% on a comparable basis. Northern Europe shows strong growth, essentially in P&C, Germany, Belgium, and Switzerland. These are markets where the prices have tended, in fact, to drop, so the plus 100% can be quite comparably compared to our different markets. However, the competitive situation is rather difficult in terms of the cycle of P&C. France, plus 3%, stronger in corporate than in individual. In the Mediterranean region, we see here, again, with a 5% growth figure, we see the impact of the growth in our revenue in Spain and accelerated growth in Turkey and Morocco and in the Gulf region. In the UK, strong growth in our business, plus 8%, with a slight drop in profitability, however. Combined ratio, compared to 96.9% last year, this slight deterioration in the combined ratio is due to natural catastrophes. We had the Kirill hurricane, which hit Northern Europe, the floods in June and July in the United States. These natural events cost us 2 points in combined ratio. So outside of these natural catastrophes, in fact, our combined ratio would have been very good. You see that the floods and storms affected Germany, Belgium, Mediterranean region, etc., whereas in other countries we have strong improvements. So Mediterranean region and Northern Europe, strong growth in P&C underlying earnings. Also in France, we have a deterioration in the United Kingdom, which is a result of growth that was slightly too strong, and of course the June and July floods. As concerns asset management, we have an average growth of plus 21% for this period. This is due to a favorable market inflow at 28 billion euros, negative foreign exchange rate of 77 due to the increase in the price of the euro compared to other currencies. But in any case, we're looking at 1 billion in assets at end of 2007. AXA Investment Managers, inflow much lower than in 2006. You know that monetary funds inflow represented -8, despite the fact that the inflow was very positive in the previous years compared to 2007. Nevertheless, our revenues are up 21%, and underlying earnings are up 31%. Third-party assets share now at 33% in AXA, which is spectacular when you think that 10 years ago, AXA Asset Managers were mainly managing assets for insurance. AllianceBernstein showed satisfactory performance, plus 15% in 15%, 14% in underlying earnings on a comparable basis. Of course, there's an unfavorable foreign exchange impact. Inflow was very good at 23 billion euros, below that of last year. And despite a few negative flows in index-based managed assets did increase, assets under management did increase, and third-party assets shares were at 85%. A technical explanation for the move from underlying earnings to net incomes. So this was for the 3.9 euros was increased by 1.175 euros. So this is slightly above what we usually indicate. The 1.175 billion euros factors in provisions of 400 million euros for impairments in 2007, mainly related to investments in financial institutions, equities, and bonds. ABS impact of about 60 million euros. Adjusted earnings 6.1. Net income 5.566. Some of the mutual funds and other assets factored in that are not in the statement, 205 million euros, with an impact of 391 negative million on derivatives, forex, to cover the change in the fair value of derivatives, forex, and others. Now, in this variation, you have a positive offset in the financial statements, but accounting rules force us to indicate this negative mark-to-market. Then we have the 480 million euro for discontinued operations and goodwill and related intangibles. These are not depreciations, these are amortizements on the value of our P&C customers linked to the acquisition of Winterthur. Our solvency remains strong from 186% consolidated European solvency to 154%. This was impacted positively by the result, even after the solvency margin coming from organic growth. We had the 2 points in growth linked to free cash flow. We have a negative impact of 31 points for capital management. 13 points, so down for dividend payment, minus 23% financial markets. This is linked to our, there's a 4 points are linked to our employee shareholding, a stock and share plan. We also have a part due to a spread on bonds, a negative 5-point negative impact on actions. At 154%, we're still in a comfortable area, which justifies the ratings we have from Standards & Poor's and Fitch, and the Moody's rating as well. A zoom now on assets. In our financial statement, we have 615 billion in assets. We have here 382 billion that are in the general funds, the insurance funds, and 183 in separate accounts. You see the general composition of our table has not changed much. Bonds, 76%, share fixed income, 78%, cash is 4%, equities 10%. Real estate is about 5%. Now let's look at on fixed income. We have almost 3 billion in fixed income investments. A little over the half, under half, 46% is in state governments and public. 46%. Corporate bonds, including CDS is 44%. So this gives us an average rating of A+, which is a solid financial rating. If we take a zoom on the asset-based securities, the 16.2 billion that I was talking about just now, this portfolio is highly diversified. We have here 1.6 billion in American subprimes, 2.9 billion in collateral loan obligations, so loans with collateral, and 1.8 billion in CDOs. These are the 3 asset categories that were considered to be problematic by the market. If we look at the rating of this portfolio in terms of credit, we see that 70% are AAA and AA. So the average rating, an average rating of very high quality. These portfolios are not trading portfolios as far as we're concerned. These are portfolios that we bought to hold them for a long period. The average holding period is 7 years. We have positive cash flow. We do not intend to sell these assets. We're not in a situation where we have to liquidate these assets. Simply, we must recognize the fact the negative impact of the mark-to-market either in our P&L or in our balance sheet. And this is something that we will look at more precisely later on. So the impact is limited. It is 0.6 billion euros net of policyholders' participation and tax. 300 million go directly into shareholders' equity, and another 3 billion the P&L in the form of depreciation in the underlying earnings, and the other in the net results. So so much for the variation of the assets. For us, this is not a situation that worries us because we intend to keep these assets until they are mature. And when they come to maturity, they will be reimbursed at their value. The mark-to-market issue will not impact them. Once you don't have the downgrade, we feel that these portfolios will have done their job, which is to give us additional revenue. It's just that temporarily we had to factor in that negative mark-to-market impact due to the temporary situation. So in total, if we try to summarize what we did in 2007 and the way we see 2008, in 2007, underlying performance is very strong, in line with the 2012 ambition, which is a long-term plan that is quite ambitious. Now, and this is important for you in a period where there's strong suspicion vis-à-vis financial institutions, with respect to what they have in their financial statements. You see that our financial statement is extremely clear, with no surprises as concerns assets. When you look at the impact of the situation on a situation such as now, as ours, well, it is quite negligible. There is one, but it's negligible. 300 in the P&L, 300 in the balance sheet, and we believe that once all of these values come to maturity, expire, we will have the same, they will recoup their value. The acquisition strategy is good. It is in periods of turbulence that solid business models can show their difference with respect to other models. When everything is fine and markets are easy, it's more difficult to tell the difference. It is when the situations become more difficult that we need to try to show our differentiation vis-à-vis our competitors and vis-à-vis the market. We are increasing our exposure to high-growth markets. You see that since the beginning of this crisis, we have made a number of acquisitions. If we did not have a serene and confident vision of the future, we would not be making these acquisitions. We make them because we are comfortable with our business model. Last point, the integration of Winterthur, as I said, and I've already mentioned this. This was no small business. We're talking about a business that weighed about 1/4 of the whole company. So it went very well, and any surprises we had tended to be good. We found high-quality product, high-quality teams, high-quality distribution networks. The complementarity is really perfect. We're therefore very pleased that we made this acquisition. When you look at 2008, since most people now are no longer interested in 2007 results, they only want to talk about the future. What does 2008 look like? We moved into 2008 with a much more uncertain economic environment. A number of shares are volatile, bearish. There is a continuation of liquidity crisis, concerns about a slowdown of the world economic growth, lower interest rates, and higher credit spreads. Now, do we see this in a negative light? No. In this environment, and assuming equity markets stabilize at current levels, we feel that if there is this stabilization at current levels, AXA should achieve positive revenue, and our figures are showing growth. This is a testimony to the faith we have in the model of our group. What is this reasoned optimism based on? It is based on the fact that when you look at the business model, business line per business line, we have every reason to believe that what we have seen up until now will continue. If you look at life, for instance, savings and retirement, which represents about 50% of our earnings, we should continue our positive cash flows. When you're in a positive cash flow situation in markets such as this one, this means two things that are key. The first thing is that you don't need to sell anything off at all because money comes in every day. So if you have any assets that you believe are temporarily depreciated, you can just sit on these assets. Not the same situation as when you're in negative cash flow and you need to sell something every day. The second thing when you have positive cash flow is that you have fresh money to invest every morning. And when the risk premiums go up, that's a good piece of news because that means that your future yields will be higher, stronger. So we were waiting, and we talked about this last year, by the way. We were waiting for a situation where the premium for risk premium, where the interest rates would be higher. We are now in that situation. It's been a bit brutal, I admit, but here we are. We cannot now start saying that this is negative. This is not true for companies such as ours with a positive cash flow. It's an opportunity for us to make new investments at interest rates that are higher. From the commercial point of view, we will now be in competition, stronger competition with banks for short-term liquidities because they are lacking liquidity. They're trying to bring in short-term clients with deposits. But our answer to that is we are looking for the interest of the customers. Secondly, the types of guarantees that we have are such that can convince men. When you talk about the USA, and people say this is the most threatened economy in the world, well, the figures are positive for January. As concerns P&C, this business is very decorrelated with what is happening in the financial markets. They depend on the growth in the motor business, in the real estate business, industrial buildings, etc. If the market slows down, well, January and February are completely in line with what 2007 was. We're at between 3 and 5% growth with margin levels that are good. And once again, we repeat now what we have been saying systematically since 2002, 2003. This is a market that is less cyclical than in the past because the players have become more responsible and because financial revenues no longer provide the kind of flexibility that would allow people to play around. So, in fact, the environment is such that the prices would either tend to stabilize or improve slightly. Now, asset management, probably the most affected business. Not that entire sections of this business are threatened. It's simply that when the markets go down, the asset bases that we have in our stock, when equity markets go down, whether it's for us or for other parties, well, temporarily we bring in less commissions. But in the long term, the trends are the same. World economies are becoming richer. Our customers are becoming richer. They need the kinds of projects that we sell, so they will be buying more and more of these products. We do not consider, contrary to what happened between 2000 and 2003, we do not believe that the business models in the insurance sector are being challenged. Between 2000 and 2003, the situation was quite different. You had booming damages, you had interest rates and equity markets that were going down all at the same time, and then throughout the world you had insurance companies with underlying earnings that were low. This is not the case today. Underlying earnings are high, businesses are growing, and therefore every month we generate results with increased solvency that gives us the capacity for new APEs. This is not the same environment. I would say that there is a turnaround. The banks were less affected between 2001 and 2003 than they are today. Conversely, we are less impacted by what is happening today than by what was happening between 2001 and 2003. This is what I wanted to tell you. You see that this is quite reasonable optimism, reasoned and reasonable optimism. About corporate governments, I wanted to say something here. We have had a significant event, which is emotionally important because it is a page that is turning for the teams in the group, but I think it's also important in terms of the group's operation and its entire philosophy of operation. Claude Bébéar, who has been a member of the supervisory board for 8 years, who spent 40 years of his life creating, developing, and enabling AXA to bloom, will not be asking to renew his current mandate as a member of the Supervisory Board. This expires on 22 April 2008. Claude is going to apply to himself the rule that we had laid down for the members of the Supervisory Board, which is that when a member of the Supervisory Board turns 70, he will, beyond that age, not request a renewal of his term as a member. We will maintain the two-tier structure, the board and the supervisory board. We believe that this is a very balanced, stable structure, which in case of a problem enables a company to negotiate crises more smoothly, and we do not believe that we should change the governance of the company based on the circumstances. In that sense, we might be different from other people, but we believe that this is a good model. We believe that it should remain in place. And Jacques de Chateauvieux, who has been an administrator of the company for 3 years, he did an incredible job of repositioning a family business, turning it into a global leader in maritime services. Many of you perhaps don't know Jacques yet. I encourage you to take a look at his history, his track record as an entrepreneur. He's an incredible model. He was able to turn a family company into a global company and to develop his presence in emerging countries remarkably. This is the reason why we asked him to join the supervisory board of AXA. We believe that he is an excellent candidate to become chairman of the supervisory board. He will be there will also be the appointment of François Martineau, who is he will be nominated as a member of a supervisory board in replacement. And lastly, the director and the supervisory board will support the presence of also an American employee, Wendy Board, and this will be submitted to the shareholders meeting. So you see that 2008 will be a more challenging year, but we're certainly looking at it with great serenity. This is basically what we wanted to tell you, and we are now ready for any questions you might have. Any questions? Please tell us whom you work for and give us your name so we know who is asking the question. Oh, excuse me. Please do not get up. I know that you have a problem with your knee. Yes, Benedict Angitile, ANSA. I wanted to know with the participation of Montepaschi, where do you stand? Are you pleased? In case of a capital increase, will you follow suit? I also wanted to know with CNP whether you have any stake. And do you still have an interest in Generali? Oh, 3 questions that are... okay, concerning Montepaschi. The operation of allying with Montepaschi was strategically important for us. You know this. We were looking with great interest for a number of years now at the Italian market because we believe that in Western Europe, this was one of the developed markets where the margins are worthwhile. In Italy, we have a medium-sized business as Curiziani, but we wanted to improve our distribution networks. Our strategic interests converge with those of Montepaschi. We acquired 50% of their P&C and life insurance subsidiaries. We believe that this is a very good operation for both companies because it enables Montepaschi to use the capital that's required to develop its distribution networks in its core business, i.e. the bank, and that gives us access to banking distribution by providing to our partner high-quality products, which they would have found more difficult to develop themselves. So this is a totally symbiotic relationship and completely corresponds to our multi-distribution strategy. We took a symbolic stake in the equity of the bank because we trust the management of that bank. And what we have seen is that since we have signed this agreement with them, they have made important strategic steps, particularly with the acquisition of Anton Veneta, which further expands the distribution networks that we are now privy to. So we're very pleased with our relationship with Monte dei Paschi. Would you like to add anything, Denis, on this score? Well, our stake is very close to 4%, in fact, in the company's equity, which is almost the maximum for any shareholder who is not a founding member. So we will be one of the major at 4%, even though the percentage is small. Nevertheless, we're an important partner, and we're very close to Monte dei Paschi. Next question. The question that I've been hearing, a question I've been hearing for 19 years concerning Generali. Well, we look at our friends from Generali with great friendliness. Strategically, however, now with our Monte dei Paschi operation, we have very worthwhile, excellent access to the Italian market at very reasonable prices. Our business in France is growing and prosperous. In Germany, our business is growing and prosperous. So we see all of this with, look at it with a friendly eye and some distance. So I have nothing further to add to that. I just pointed out in July the fact that if there were any change in the present situation, we would express some interest. What I'm amused by is that probably this is not such a bad idea, since all of the competitors suddenly also showed some interest in this operation. Well, we'll see. We'll see. And that's it. Yes, regarding Atelier Gironi 24, Monte dei Paschi, about Monte dei Paschi again. What do you think of the high price paid by Monte dei Paschi for the vendor, 9 billion euros? You know, this is something that we're used to hearing. Since I have been with AXA, if Claude Bébéar were here, he would say the same thing. Whenever we carried out a strategically important operation, is people tell us, you paid too much. That we paid too much. 3-4 years later, well, people change their minds. And I think that the Monte dei Paschi's management carried out a brilliant operation, because in carrying out this operation, well, they consolidated their position in the Italian banking world. This is 1,000 additional points of sale. When you look at the critical importance of having points of sale in the European banking market, well, you can see that they were right to carry out this operation. Of course, nothing comes for free anywhere, and everything has a price. But when you compare this to the potential in synergies and development and the strategic importance of this operation, well, you immediately understand the fact that this was the key to move to the next step. And keys do not come for free. I think that this was a very intelligent operation. It enables them to be differentiated from other establishments whose structure, etc., were not very different from theirs, and missed this opportunity. Yes, I would like to come back to the impact of the financial crisis on slide 32. I must admit here, I can't quite remember. Is the 16.2 billion euros or the 60.3 billion euros is the most critical part of your investment in your ABS structure or in the held to maturities? Or what is the risk that in this portfolio there might be further depreciation in 2008? Because if you compare it with depreciation in other banks, the 600 million euros, up front, I find that this is not a very strong impact. Up front, it could create the impression that there are some other things in the pipeline, that in the future, this is something that could frighten the market. Second question, AXA has a liquidities counterpart for the monetary fund. That means you bought part of the investment fund to keep your customers. Société Générale did the same thing and did a depreciation on this asset that they bought. I do not find a figure of the impact of this action. In other words, what did you buy back in the investment funds of your clients, and what was the impact of that? Okay, as concerns a portfolio, the slides that we showed earlier on does not give us much detail. If you look at the annexes, you have details, a level of detail that is peerless in the market. For each generation of subprime, we give you the breakdown with a AAA, AA, single A, the market value for each one of these tiers, huge level of detail. And you will see that the low ends and the high ends, what we have applied in both is very close to the market. 1% of the portfolio is valued on the basis of internal models, but 99% is valued according to the market. Now, to compare valuation between different establishments, you cannot use the sums in absolute value. You have to look at what the underlying assets are. And you need to understand why some assets are worth 20% and others much less. There's a very good reason for this. Now, why we did not put this in held to maturity? Well, either because they were available for sale by P&L or by the balance sheet. And what we do is we give you for each asset the share of the portfolio that is available for sale for the P&L and the share that is available for the balance sheet. So out of the total of 16 billion, the value reduction for the year 2007 gross is 1.5 million euros. That's about 10% of the portfolio, but there's some segments where the depreciation is 70 or 80%. So again, we were extremely transparent and open about this portfolio. This was audited very carefully by our auditors. I think that you can be completely confident as regards the values we give you here. Now, this portfolio continued deteriorating further in January because credit spreads continued to deteriorate as well. This is not linked to the American subprime situation. It has to do with the fact that the credit spread is expanding generally. However, we're not worried by this situation because we will be holding these assets until their maturity. We did not classify them in L to maturity. We believe that they generate a sufficient return, and we continue to get the coupons from these portfolios. We don't have any downgrade or only in very insignificant levels. We have no concerns with this portfolio. We're not like a bank, which has this in a trading context. We're not obliged to sell them. We keep them. It's very important for you to understand this. These assets are, you have the assets on the one side, the liabilities on the others. It's not an effort to keep these assets. It's just a matter of good liabilities and assets and liabilities management. People are expecting for us 8 years, 20 years, 40 years from now to be able to pay them back. We do not need liquidities in relation with these assets. We need assets that we can keep in the long term, and we have cash flows which are positive year after year, and this enables us to buy further assets. The next one, the LIBOR Plus fund, it's true that we bought close to 80% of the outstandings. We bought them at market prices. In August, we bought them at their market price, meaning at the time with a down mark of about 30%. The market continued to deteriorate because there were no liquidity, so we had an impact on our 2007 accounts of about 70 million euros. And this is in the net income of AXA. That's where it's factored in, no mystery here. We saw a deterioration in this portfolio after the share buyback for CD clients. We're not worried here again by this portfolio because there was no deterioration in the credit quality of the underlying assets, and we will be keeping them until their maturity, on the average 2 or 3 years. So no concern there. One day we will have to look at and wonder about the relevance of accounting standards. We had said, and a number of others did as well, that when IFRS came in, that the day a crisis comes in, there would be a greater risk of volatility, and that this type of presentation would not necessarily give a very faithful reflection of what assets are. What happens is that it gives a picture of a situation where in the market people have to sell sometimes under duress, whereas some of the assets are not degraded. Now, for some assets, maybe there are some durable losses, but also there are many situations where people are just taking provisions that they will put back in 3-4 years ago when people realize that today's vision is much too pessimistic. So the accounting standards that were not applied in the same way in previous crises, these accounting standards have created volatility and anxiety. A number of points are considered toxic. You yourselves wrote that there were problems with the mezzanine CDOs, the subprime CDOs. We almost have no assets of this type in our portfolio. We did not buy all of these assets, being as innocent bystander participants in the market. We have some ABSs in the structured finance AXA division. They do this extremely professionally. We were not innocent victims of banks who perversely set up structured products that we did not know. This is a business that our asset managers know very well. We have structured products for our clients and for insurance companies, and we have no problems with the value of the underlying assets. Yes, hello. Garavie Squeezy from Bloomberg. Your stock price went down this morning. Traders say that this is because your prospects for 2008 are more moderate or nuanced or less optimistic than in the past. Is there something that we should know to understand why they adopted this position? No, I think that we have to remain relaxed when you see this. In fact, it's dropping less now than it was at the beginning of the morning. No, I'd say that our prospects are a little more moderate than when the markets were significantly higher, but they are nevertheless positive. When we say that, when we said that if the markets stabilize at the present levels, the growth in revenues and underlying revenues will still grow. Well, this is not a negative statement, far from it. We're in a situation where the markets are highly volatile on a day-to-day business. We're also in a situation which is very exceptional in terms of valuation of the insurance industry. In fact, it's quite absurd because when you look at, we are at 5% return right now on our dividends. Even at the worst situation, we were not at 5%. Previous worst situations. There is a crisis. There's a fear. There's some anxiety. I think that in financial protection or insurance companies will go through this crisis with no damage because their operational models are not being challenged, not being questioned. Yes, a point regarding prospects. In last November, the prospects were, based on the markets at the time, growth of our results in 2008, we had said high single digit, low double digit. So that's around 10%. And the reason why this was already lower than our average in the previous years was due to the impact of the dollar. We're now in a situation where since this time, markets lost, since the beginning of the year, about 10%. The share markets, not far from 15% since November, and the dollar has continued to become weaker. This will necessarily have an impact on our results in life insurance and asset management because our asset bases are smaller. But the situation, as we said, for P&C is nevertheless very good. We have a business mix that is highly diversified, and so the overall situation is extremely positive. Our market price, our share price, does not reflect the actual situation we are in. Pascal Denis, Reuters. Reuters. In your 2012 ambition plan, your annual your aim is a plus 15% for underlying revenue growth. I wonder what you think for 2008. Will this be achieved or not? That's my first question. The second question had to do with emerging countries. You said that you're not present there enough at the present time. What are the countries where AXA would like to be more exposed? And the third is, could we know what the total is for acquisitions in 2007? What you spent in total? Okay, in our Ambition 2012, what we said is that in the long term, our revenue would increase by 15%. You have to be naive to think that this would be the case every single year. Since 2004, we have been continually ahead of our objectives. If you look at the growth in underlying earnings in 2004, you can see that we're at 22% on average during the first years of the plan. 2008, as we just discussed in the previous question, is a situation where, if nothing changes, the improvement in our underlying will be slightly lower than in previous year, which does not mean that we will challenge the 2012 plan. First of all, because we're ahead of time, and secondly, because we do not believe that this situation of a deterioration in the markets is durable. So when we talk about reasonable volatility, this is around a trend which remains unchanged over the long term. We do not question the objectives of Ambition 2012. As concerns the second question, exposure to emerging countries, well, we increased our exposure last year. We bought back minority participations in a number of countries. In some countries. We increased our exposure in Central Europe. Korea and Vietnam, we were also active. Mexico, we were active recently with the ING PNC subsidiary. These are areas where we want to continue to work if interesting opportunities come up. This does not mean at any price. We buy when we believe that conditions are reasonable. We do not like to overpay. So most likely this will be in the same regions, and if the circumstances are positive, the prices are reasonable. Third question is the sums. If we reason in cash, what was spent in 2007, we're talking about 3.4 billion euros. I would like to point out the fact that we spent 3.4 billion in acquisitions for acquisitions. But we also collected 3 billion through sale of assets such as Winterthur in the USA. We withdrew from mature countries and moved toward countries with high growth figures, with transactions that have been announced but not paid yet. The one mentioned by Henri just now, Mexico, Russia, and Turkey. We have 2.2 billion in announced operations, committed operations, where actual cash payments will be made in 2008. So in total, for the 2 years between what was announced and what is done, we have 5.6 billion total, compensated by 3 plus billion return through the sale of assets. I would like to come back to your presentation of ABS and the crisis, because indeed the impact is 600 million. But when you look in the presentation you made, the real impact is 1.5 billion. So it is 10%. So having an impact on your ABS commitments to the tune of 10% is quite significant. You seem to be extremely optimistic given this year that's beginning, at a time where nobody has any visibility. I'd also like to know whether you have an exposure to monolines in the USA. I have another question, which is you have a solvency ratio that has deteriorated Do you think that you will be able for 2008 to change things? Dominique? Marriott is charming, but very pessimistic this morning. Okay, the 16 billion or 1.4 billion to the 600 million. Denis told you 16 billion, that's for the total portfolio. Now, not all of the risk is on the shareholder, or rather the investor. Some of it is also on the insurance company, which reduces the 1.4 billion. Then you have the mitigating effects, such as tax. That's how you move from 1.4 billion. You have the share for the insured and the share for the tax. 10% appreciation on portfolios that we knew were high risk, but that aimed to generate additional yield, we believe is a figure that is significant, but not considerable. I'd like to recall the fact that, I mean, if you look at an asset that is completely depreciated, you're going to conclude that it lost 100% of its value. That's for sure. But you need to look at the whole thing. All of the bond portfolio is 300 billion euros. Out of these, 15 or 16 billion are in ABS. This is a proportion. That's 5%. Now, out of that 5%, you have a sudden depreciation of slightly under 10%. Well, that's 0.5% gross impact on the total portfolio of the company. We do not believe that this is something that could lead to tearing one's hair out. Now, we would have preferred less, of course, but if you compare this to an impact of the movement of interest rates, plus or minus 50 base points, that's what I meant to say. If the interest rates increase by 30 base points on a fixed income portfolio, you have a value loss of 1.8 billion euros. So we're talking about government bonds. Government bonds, if you have any doubt of the reimbursement of the American government or the French government, do you have any doubt? No, not really. Well, that's how the mark-to-market works. 30 base points on my portfolio, 1.8 billion euros. We're not worried. On ABS, we have the same phenomenon. We have no issue with the credit quality on ABS. We have no issue with this, but in January, the ABS portfolio lost further value, a little under 5%, but 80% of this loss is simply the increase in interest rates in the bond market. Now, you might be very worried by these issues, but we, as professionals of this issue, are not worried at all. As Mr. Chirac said, no, we'll skip that. Okay, as concerns solvency, do you want to say something about the monolines? We have an exposure that is 800 million euros. This exposure is 800 million euros. Over half is covered by our UK with profit. Largely more than half is in corporate bonds, not ABS. It's an exposure that 3/4 of which is on MBAC and MBIA, which are the two monolines that seem to be the least affected. So we have a situation here that is not problematic. Also, we wanted to mention a reassurance runoff for AXA Re. We have some, we're talking about AXA Re Finance had a credit, monolines business with outstandings were about 7 billion euros. This was broken down over 5,000 municipalities. And this portfolio, because of the fact that it was placed in a runoff in 2004, is refinanced by MBIA. So we have a first tier risk on American municipalities. We had 0 incidents, 0 default in this portfolio, which is not, we're not losing any sleep over it. So all of this is not something that we lose any sleep over. Okay, SIV. We sold DLJ in 2001. That was the investment bank in the group. We're not an investment bank. So we don't have any SIV. We don't have any conduits. The companies in our industry who have had conduits were banking companies, particularly investment banking companies. When you talk about Allianz and others, we're not involved in this business. We don't have an SIV, etc. We don't have these concerns. Okay, Dominique's last concern, the regulatory solvency ratio. Here again, we feel completely relaxed. The regulatory solvency ratio. You'll see that our competitor on the other side of the rain whose name starts with an A, their solvency ratio is about at the same place as ours. These are double A ranking positions. Did it budge? Yes, about 30 points less than last year. You read this and you deduct from that that in fact the group is in a very solid position. Why? Well, first of all, because we generate, based on the level of our results, 2.5 points in additional points in solvency, since we generate about 30 additional points of solvency. This is a situation which is extremely different from the situation in 2001, 2003. At the time, corporate profitability was much lower, and their capacity to reconstitute solvency margins was much stronger. Here we're generating 2.5 points per month. What are they used for? They're used for financing the growth in our business, financing acquisitions, and compensating any drops in the market if necessary. When you look at what we did last year, we ourselves provoked a drop in our ratios by buying back shares. You think we wouldn't have done that if we didn't trust it? By making acquisitions, we continued our acquisitions ever since the markets have come into a turbulent period. And when you add on the cost of Russia, of Mexico, of the minority stake in Turkey and Morocco, I think, well, you see that eats up some of your solvency margin. Now, we're not worried about this. Yes, a drop in the market has an impact. It does not disturb us in the least. Why? Because the capacity to rebuild this margin through operational profitability is very high. And we consider that this is a very efficient way to handle capital. We're not here to sit peacefully with too much capital, which thereby becomes less remunerated than it should be. We're here to have the capital we need and enough of it. So the issue of solvency does not worry us at all. Yes, Chicago, Reuters. AXA holds a stake of a little over 5% in BNP Paribas. In January, BNP Paribas said that they were going to study the file of BNP Paribas. Do you think that BNP Société Générale merger would make sense? Would that be a good transaction for the BNP Paribas shareholders? As a shareholder of BNP Paribas, we're very reserved, very discreet people. Next question. Thomaris, Swiss Financial. I have a question regarding your prospects. You say that, supposing that the present markets stabilize, supposing that the markets, financial markets, equity markets do not stabilize, does that mean that if there's a slight adjustment of 10, 20, 30%, you will not be making any more profit or underlying earnings? Okay, now you said you're very pleased with the Swiss. Is there any possibility of making any other equally brilliant acquisitions in Switzerland? Okay, regarding the first question, the answer is obvious. What's important is what would have been the average level of the markets over the year. It's not where the market stands at a given point in the year, it's the average level during the year, and then the closing level to see whether you need some provisioning for some shares or not. If the market goes down somewhat and then goes up, it's fine. If it goes only downward between now and the end of the year, obviously the prospects will be a little less positive. However, we're not going to depend based on the level of the market. We're not going to change our guidance every year. We think that there was a significant adjustment, a correction. But we said that if the markets stay about at this level, our growth, our revenue and underlying earnings will grow. If it goes up, we will do even better. If it drops further, it might be a little less good, and we'll see then. But we're not going to go into day-to-day forecasts. As concerns our Swiss friends, we're very pleased. Our main issue with Switzerland right now, given the market shares we've already accumulated there, is not so much to buy additional businesses, it's to show that we can do more growth with the acquired businesses. Freddie, do you want to say anything? Yes, I think first and foremost, when you look at the positions that we want to have in the developed markets in Western Europe, I always say that we need 10% market share in medium-sized countries. We need a position. We need to be in the top 3 in all, and in all the big markets, we have to be in the 5 top companies. Now, in Switzerland, we're doing okay, except for life, which is more difficult. Now, when you talk about life, you always have to look at all the other players in the savings market, and this would include the banks, and they have many other instruments over and above just life insurance sold by insurance companies. So we certainly had a situation that is more vulnerable and weaker there in life insurance, and particularly individual life insurance. What we're doing now to counter this is introducing new products and focusing. We have the factory, the plant. We have the distribution. We're number 1 in Switzerland in damages, in P&C. In life, the aim for us, I don't see why we would buy something new. The aim for us is to get this engine, this beautiful engine that we bought in Switzerland, to work even better and to produce even more. We'll take a last question. Mrs. Duguigné. Anne Duguigné, Journal des Finances. I have a question regarding your corporate bond investments. What is the proportion of CDSs? And whether these assets could not become dangerous in the event of a deterioration in the market. We have about 13 billion in CDS. I don't see any particular danger linked to CDS. 75% of our CDS investment is through an index called iTraxx Main. This is a very liquid index. There is some volatility, of course, so there's a risk, which is the mark-to-market. Here, if the credit spread increases, as it did since the beginning of the year, it does lead to a loss in the mark-to-market. But CDS per se does not show any particular risk. There's a huge amount of liquidity in this market, so we're not worried about this portfolio. We have a CDS portfolio. Why? Because we have general account fund. We used to have complete government bonds, and we wanted to basically create more corporate bonds. So we're not very worried here. The reason we did this is that why do we have less CDS in single names? Well, simply because there's less liquidity in the single name CDS, and because the index underweights financial institutions. Okay, thank you. Good day.